Ever wonder how an insurance company can promise to pay for a catastrophe that hasn't happened yet? Well, it's not a crystal ball, and it's definitely not guesswork. It's actually a really fascinating field of mathematics. And today, we're going to pull back the curtain on how they turned the messy data of past events into a powerful forecast for future risk. Okay, so let's just start with the core question, right? How does an insurance company actually put a price on a promise? On a commitment to cover something that might happen, or might not, at some unknown time for some totally unknown cost. It's a really high-stakes prediction game, and their secret weapon, believe it or not, is math. So here's our game plan. We'll kick things off with why insurers even need to predict the future. Then we'll look at how they hunt for clues in old data. After that, we'll see how they make that big leap into a predictive model. We'll even peek inside their mathematical toolbox. And finally, we'll connect it all back to the real world and your policy. All right, let's dive in. Section 1, Insuring Against Uncertainty. This is all about the high-stakes math that's humming away quietly behind every single insurance policy out there. Now, this isn't just some academic exercise. This is the absolute foundation of an insurer's survival. These predictions drive every single critical decision they make: what premium you pay, how much cash they have to keep on hand for future claims, how they manage their own risk, and even how they prove to regulators that they're financially stable. I mean, if they get this math wrong, the entire house of cards could come crashing down. So that's the why. Now let's get into the how. Section 2 is all about looking at the shape of past losses. Because, the key to predicting the future is almost always hidden in a careful reading of the past. A great way to think about this is like weather forecasting, but for money. If you want to predict future hurricanes, you don't just guess, right? You start by meticulously studying the data from every single storm that's come before. It's the exact same principle here. Okay, take a look at this. This is what real-world claims data often looks like when you plot it out. It's called a histogram, and it tells a story. See that big hump in the middle? That represents all the common, everyday, predictable stuff. The little fender benders, the minor property damage. But that long, flat part stretching way out to the right, that's the long tail. And that's the scary part. That's where the rare but absolutely catastrophic events live. And this right here, this is the central challenge. This historical data is vital, but look at it. It's messy. It's jagged. You can't just connect the dots and expect to predict the future. To do that, to make a reliable forecast, you need to transform this rough history into a smooth, elegant mathematical model. Which brings us perfectly to Section 3, from data to distribution. This is where we make that huge intellectual leap from just looking at what happened in the past to actually building a tool that can predict the future. Look at this slide. This is the whole magic trick right here. On the left, you've got the chaotic, messy reality of historical claims. On the right, you have a smooth, perfect curve. An actuary's job is to find the mathematical function that best fits that raw data. Kind of like an artist sketching the general outline of a mountain range without getting bogged down in every single little rock and tree. This process captures the essence of the past in a way that lets us project into the future. And that beautiful, elegant curve, it has a name. It's called a loss distribution. It's a statistical function that doesn't just describe the past, it models the size of potential future claims. It allows an insurer to ask with real mathematical precision, hey, what's the probability of a claim costing more than £1 million? And the model, it can give them an answer. Okay, let's keep going. Section 4, a toolbox of models. Because, as you've probably already guessed, not all risks are shaped the same. So you need different tools for different jobs. Think about it like this. The risk of a minor fender bender, which happens all the time, has a very different shape than the risk of, say, a massive factory fire, which is incredibly rare but financially devastating. You just can't use the same mathematical tool to model both of those things. So actuaries have this whole toolbox of different loss distributions. For those common, predictable claims, they might use something called an exponential or a gamma distribution. But for those rare, catastrophic events lurking in that long tail we talked about, they need specialized tools, like the Pareto or Weibull distributions. These are specifically designed to handle those extreme values, making sure the insurer is ready for the absolute worst-case scenario. The crucial takeaway here is that picking the right model is absolutely everything. Insurance claims data is what we call positively skewed, which is really just a fancy way of saying there's a long tail of very rare but extremely expensive events. A model like the Pareto is designed specifically to account for these massive outliers, which, if you ignored them or model them wrong, could literally bankrupt the company. And that brings us to our final section, why this math matters. Let's connect all these abstract models directly to the real world and to your wallet. First, we've got to talk about a real-world factor that completely changes the data, the policy excess, which you probably know as your deductible. It's simple. It's the amount you have to pay yourself before the insurance company pays a single penny. So, for example, a pretty common car insurance deductible in the UK is £200. Now, think about it. If you have a claim for £150 of damage, you're not even going to file it, right? So, what does that mean? It means the insurer's data has a giant blind spot. They never even see all of those small claims. The data is truncated, and the mathematical model has to be smart enough to adjust for this missing piece of the puzzle. So, let's put it all together. Here's the playbook. First, the insurer collects all the claims data they actually see. Then, they pick the right distribution model from their toolbox to fit its unique shape. After that, they use statistical methods to fine-tune that model. And then, and this is the whole point, they use that final, perfect model to calculate the probabilities of future losses and set a premium that's fair, but also sustainable. So, at the end of the day, the crucial point is this. All this complex math we've been talking about isn't just for show. It's the engine that powers the entire insurance industry. It's what allows them to put a number on uncertainty, to manage risk, and, most importantly, to keep their promise to be there when you need them most. Which leaves us with one final thought. The next time you pay your insurance premium, think about this. Are you just paying a fee? Or are you buying your own little piece of a very complex, data-driven prediction about the future? Thanks for joining me.